We've got a number of 6.8% as far as IIP goes for the month of January. It is sharply above the December number of 1.8%. And we did take you through the breakup. The disappointment within that really is electricity, which has grown by 3.7%. Manufacturing has seriously surprised on the upside. It's coming at 8.5% against 1.8%. And to make sense of all these numbers and to give us, paint the outlook for us going forward, we've got with us on the panel this morning Irfan Razak of Prestige Estates, who joins us on the show from Bangalore. We've got Anjan Barua, who's Deputy Managing Director at State Bank of India, Vijay Mantri, MD and CEO at Pramerica Mutual Fund, and also Samiran Chakrabarti, who is Regional Head of Research at StanChart. But Samiran, a quick word from you. 6.8%. Do you believe this just strengthens the case for the RBI not to do anything on Thursday?
I'm sure, as like other panelists mentioned, that RBI looks at a broad set of activity numbers and not just IIP. But whether we like it or not, this IIP number will straight away get reflected in the GDP number. So we might doubt the integrity or the quality of the data, but the fact remains that we will now probably see a better fourth quarter GDP as well if this trend continues in February and March as well. So RBI will have to look at this data as well to make a judgment on the interest rate side. We have been talking about the December ending quarter to be the worst quarter in this cycle. So the January number clearly shows that probably we were right on that front, that probably from now on we'll see somewhat better numbers, but somewhat better does not mean a 6.8 direct jump from 1.8. So clearly the 42% consumer durables goods number, I need to go back and check exactly which items have grown so much in this month, because clearly this was not a number which was expected.
Absolutely, because, you know, the forecasts of the polls also that we were working with, they range from a number of a decline of 1.2% to as high as 4.6%. 6.8% certainly has come as a surprise. And as Vijay mentioned, the markets are saluting that. As we speak, it's 0.6% higher for the Nifty, 5369 on last count. You've got the Sensex, which is working with 17,619. It has been fairly buoyant, so not too much of a reaction is what you're seeing, and as we speak, the markets are tempering off. That's the capital goods index, 2.3% higher, despite the number not seeing a positive uptick. L&T, Punj, Lloyd, Havells are some of the counters which are doing fairly well from the capital goods index as we speak, as is the BEML. Suzlon is higher by 1.5%, and BHEL higher by 1.2%. The Bank Nifty also should be brought up on your screen. Most of your banking counters are in the green, barring an HDFC Bank. Mr. Razak, wanted to just bring to your notice this time around with respect to the kind of number that we've got. What are your expectations then from the RBI?
See, now we've been talking about even interest rates. One positive is we are not talking about it going up. Now the only thing is we are all of us agreeing that the only interest rate has to go down, and it's only a question of timing when. I agree with the rest of the panelists that it has to happen and will happen mostly only in April, and it won't. Nothing can happen this month. And the numbers, as I said, I was positive. Things are on ground looking good. And these numbers are not a surprise. Of course, the huge volatility in terms of the great jump, somebody really has to do an analysis and really find out exactly what went, making those numbers look so good. But at the end of it, on ground, I think with the bold budget that we are expecting, I think if I was the finance minister, I would just say, go ahead and bring certain things that kickstart the economy once again and make things happen. And let's see, by the end of the week, things will pan out and we'll know much more than what we are today. And I believe that the only way forward is to bring in a positive energy into the market, and towards that end, things are moving that direction.
Sure. So, Mr. Razak, if there were three things that you'd like to see the finance minister do on Friday, what would they be?
Now, the main thing is a total positive energy towards development, and that is focus on infrastructure, and also putting in a whole lot of reforms in terms of bringing in whatever they've been talking about, the new direct taxes code and everything else. If that comes in, I think we'll be looking at. I mean, I'm not looking at concessions. It's basically setting a route, a path where we have clarity and which will give us a complete direction in which direction we are going through.
Samiran, lots of divergence when we're talking about the overall number for GDP, but the fact of the matter does remain that the geopolitical worries are looming large. There is also the export prices, oil prices do remain high. Do you think that overall for the situation for FY12-13, for the Indian economy, it does remain challenging and we perhaps might not see anything significant on the horizon that would change that view?
Certainly, there's no doubt about that FY12-13 will present its own set of challenges. There is some good news and there is some bad news. The good news is that probably an event risk in Europe has been averted with the Greek problem being thwarted for the time being. The bad news from the global side is that oil prices is at a level which is not good for India from any way you want to dice the data. The challenge also is that in today's context, how much monetary policy easing can one do when inflationary fears are lurking around the corner. The second set of challenges is that how much fiscal consolidation can one do with all the political compulsions. And the third challenge is that whether to defend or not to defend the currency. I think in my mind these three will be the primary policy issues for FY12-13.
And Vijay, to present that same question to you, would you believe that only perhaps when we can see interest rates softening and that all of these geopolitical and macro concerns fading, that the situation for the overall Indian economy will be perhaps less challenging for FY12 and 13?
I think the challenge will continue to remain there. I think the biggest challenge as we see is that how does one revive the investment demand in Indian economy? Because if the investment demand is revived, then you see some action happening on the manufacturing side, and that is very good for the export. I think what we are seeing on the global factor, one is definitely the euro crisis for the time being is put on put on hold right now. I think US, we are seeing interesting data point. I think US would be showing some sign of recovery than what many people has expected. I think for India is one of the biggest export partner. So export, we see some, in spite of recent challenges we see some sobering effect in export going back to their old days. If you look at Indian economy, we believe that April, May or June onward, you see interest going down, because if you have a bank CD or corporate paper available at 11.5% or 12%, why do you put a plant of 5,000 crore or 10,000 crore? Because you can get same kind of return on putting your money in the bank deposit and the corporate CD and CP. So very clearly when the interest rate goes down, there's a more incentive to put that money to the risk users, and the risk users to put money for the businesses. I think the government can take care of a couple of things. First and foremost, I believe they take care of coal linkages. I think that is the biggest concern people are putting manufacturing plant have. And that doesn't require actually parliamentary approval. That can be done by the government itself. So if you ask me, I would look at interest rate. I would look at coal linkages. If these two things are being taken care of, I think we would see investment revival. We see Indian economy reviving, and we see market in much better shape than what they are today. Because a lot of global money available which would like to come to India.
Mr. Barua, just wanted to get your view as to where you are likely to see the yield on the 10-year bond stabilizing in light of the fact that we have had a 75 basis point CRR cut as well as the 6.8% IIP number.
I hate to disappoint, but I think on 31st March we should be seeing it close to 8.35.
And what are you seeing on course for the next 6 months? Where do you see the yield stabilizing? And perhaps do you see it going anywhere lower? And on what factors would that be contingent on?
I think the liquidity pressures will continue to be in the system. And therefore, I really don't see the 10-year yield really moving down below 8%, which most of the market participants are expecting. So we could have a trading range for the next 6-7 months between 8.20 to 8.70. And most likely, in the second, that is in the quarter beginning April, May, June, we could see towards the end of June, the yields around 8.6.
All right, I believe we have Mr. Harsh Mariwala now joining in once again, the Chairman and Managing Director at Marico. Mr. Mariwala, is my voice reaching you?
Yeah.
Okay, we were talking about how the industrial production figure has been slowing sequentially over the past 2 years. The pace was at its slowest since mid-2009. With a number at 6.8%, do you believe that things are actually going to turn for the better, or it just underlines all the unpredictability and volatility in the IIP?
No, I think for any right conclusion to arrive at, one has to see a trend and not just look at 1 month figures. So as you rightly put it, trend is very important. The trend is positive for the month of January, but to even out the uncertainty, it may be better to take a 3-monthly moving average. Because ultimately IIP figures are lagging indicators, and leading indicators would be the demand for all these items. But clearly, even the January data shows that the consumer non-durable has done well. But as against that, the durable part and all the capital goods also still has to recover and still in negative territory. So it's very important that the interest rates, which have been very high, and the liquidity, which is short, I think immediate steps are taken on that front so that the industrial production on these also would improve.
Right, and Mr. Mariwala, just focusing specifically on your sector and on your company, what do you believe is actually going to drive demand? Do you believe it's going to be rural markets going forward for you? That's really going to be the big kicker in terms of demand?
I think the big kicker is going to be actually inflation under control, because ultimately inflation eats into the consumer budget, and I think whether it's urban or rural, both are very important. Inflation has to come under control, and for that to come under control, supply side initiatives have to take place, and some of them are long-term initiatives on the supply side, especially on food front. So I think it's very important that inflation is contained and the government takes steps to improve the supply side of the equation, so that overall the burden on the household because of high inflation is reduced.